Essential business news as it breaks. Now on BBC World News, live from Singapore, Asia Business Report.
Falling exports, China's latest trade figures may show a significant slowdown because of the holiday effect. And DBS earnings. Southeast Asia's biggest bank is betting big on its business from Greater China. Hello and welcome to this Friday edition of Asia Business Report. I'm Sharonjit Lail in Singapore. We begin with China, which is releasing its latest trade figures this morning. We're expecting to see further signs of a slowdown due to weak demand from Europe's troubled economies. China's exports are forecast to have expanded 4.8% in January from a year earlier, while imports may have inched up 0.5%. China's January export and import growth may also have been hit by the Chinese Lunar New Year, which fell in January this year compared to February in 2011. Chinese factories typically shut or run at half speed during the week-long holiday, which delayed shipments and may have distorted the real picture. Well, for more, we're joined live now from Beijing by Qian Liu of the Economist Intelligence Unit. Welcome, Qian. So tell us, is this a slowdown that we're expecting, possibly a symptom of the Lunar New Year, as I just mentioned, or longer-term concerns about the Eurozone slowdown?
I would say it's a combination of both. Generally speaking, one doesn't need to read very much into the monthly trade figures as they can be very volatile. But we're really expecting to see a significant drop in both the export and import for the January number and in the coming month and throughout the year. As I said, it's a combination of both the weak external demand coming from both US and Europe. And the Chinese Lunar New Year really made it even worse because that means there was simply no manufacturing, no shipment whatsoever.
And of course, we know the Eurozone, as you mentioned, there is a concern. Just today, we're seeing Greek leaders come up with a resolution to try to take to the Eurozone. How much of a worry will that be in the longer term for the rest of the year, for instance? Because, of course, the Eurozone is a huge trade partner.
Absolutely. EU is China's largest export destination, and the Eurozone crisis is not yet over. Although in recent weeks, we've seen that the financing pressure in the Eurozone has been eased a bit with the liquidity injection from the European Central Bank. But as I said, the crisis is not over yet, and that means for China that by any chance there will be a deterioration in the Eurozone area, the China's domestic demand will find it difficult to catch up and offset the weak external demand.
All right, and inflation was another number that spiked in January. That's a huge worry for the Chinese authorities. It's a big worry for policymakers as well, because there was a lot of criticism leveled at them that they overcompensated the last time around in 2008, injected far too much money into the economy, and hence the inflation worry, the headache they've had to worry about for the last year.
It's true that there was some loose monetary policies from the Chinese government in the past couple of years, but the Chinese government has realized that, and there was a whole series of interest rate increase last year. The inflation will still be the top priority on the government's agenda. So we'll see that especially with yesterday's CPI number, chances are the government will not decrease their interest rate soon. What might happen in the first quarter is that there will be a less than 8% GDP growth. Right. And when that happens, the government will try to decrease the interest rate again.
All right, we'll have to leave it there. Qian Liu there from the Economist Intelligence Unit. Thank you.